Hello everyone, thank you for coming our group presentation. Today we are going to talk about the UU Early Education Robot. This presentation has three main parts. The first one is discussion about the evidence of the potential financial viability of business revenue supported by cost and revenue projections. This part will be displayed three tables which including cash flow statement, balance sheet and income statement. The second part of this presentation is clear justification and rationale for projection presented. The last one is discussion of the potential sources of startup funding. This presentation will take about 20 minutes. Now let's move to section 1. With the rapid development of society, many parents have become less and less to spend time with their children or communicate with their children due to work or other reasons. It is even more difficult for children to learn and educate. In addition, some areas in UK have different education opportunities. Over time, it is very unfavorable for the development and growth of children. There are three solutions can be solve this problem. In the first place, parents could find a teacher for their children, but this way need invest higher costs and spend more time to looking a good teacher. And the second one is finding a counseling agent for children. However, this program does not apply to small cities which do not have this institution. And the last one is by an early education robot for children. In this large social demand, intelligent education robots can help children to solve this problem. The UU Early Education Robot is human-oriented and uses artificial intelligence. It can help children improve their interests in learning and develop study skills. It has teaching suitability, expandability, and interesting. Additionally, early education robots can effectively improve children's information technology in the digital age. Also, parents could save time and do not need to worry about their children's education. Therefore, this is the most suitable solution to fix problem, and it has a greater education value as well as good market prospects. And this is cash flow statement for UU Early Education Robot in 2019, 2020, and 2021. The cash flow statement is one of the three basic reports of financial statement. From this table, we can look at increase or decrease in cash of UU during these 3 years. This is financial statement that provides aggregate data regarding all cash inflows company receives from its ongoing operations and external investment sources, as well as all cash outflow that pay for business activities and investments during 3 years. According to data analysis, we can know UU has a good ability to achieve benefits in the future. In addition, the cash flow statement can help companies more clear about repayment ability, capital turnover ability. Furthermore, it is conducive to strengthening funding management and ensuring a reasonable direction of funds, and also help to understand standards investment risks and carefully predicting future development. Now turn to next part. My partner will analyze UU income statement and balance sheet.
I'm going to analyze the year's income statement and the balance sheet. This table below shows the statement of year's operating results in 2019, 2020, and 2021. The sales is the source of cash flow from the company operating activities, and it is one of the important indicators from evaluating year's market competitiveness and profitability. It can reflect year's sales, cost of goods sold, and operating expenses, and finally calculating the net profit. As you can see from the sales, the price of the other education robots is the 1,000. For the reason that use the pricing strategy is the basis on reverse pricing method. It means that we use the calculate the price of the other education robots after calculating the company's operating costs and the profit based on finally price that the consumer can accept. There is an upward trend in the number of the sales in your company, which can prospect the company's operating prospects are getting better. The cost of the goods sold refers to direct the cost of the producing goods in a company. In 2019, the cost of the goods sold is expected to be £200,000. In 2020 and 2021, the cost of the goods sold is the same. This is the gross profit formula. Its purpose is to calculate the gross profit of the user per year. Through the gross margin formula, we can analyze when the gross margin is higher, the profit of the user is stronger. Finally, from the year's income statement, we can analyze that the profit rate of the year's company is becoming more and more high. Next, I will use the balance sheet, which is very important for investor. This is an accounting statement that reflects the assets, liabilities, and the equity of the years in the next 3 years. As you can see, as the time goes by, years accrued assets are becoming more and more high. As prospects, the year's ability to pay and liquidity has becoming more and more strong. The credit ratio is the measure of the ability of the year's credit assets to become cash to repay debt. Generally speaking, the higher the credit asset ratio, the stronger the company's cash stability. And my partner will introduce her parts.
Now, I will introduce the clear justification and reasonable for projections principle. Reasonable revenue and cost forecasts can help companies to formulate and operate various plans and help companies succeed. In the stage of entrepreneurship, cost prediction is much easier than income prediction. The company's cost forecast includes fixed cost, management cost, variable cost, and labor cost. Among them, management costs includes rent, advertising, and marketing costs generated by UUVs. Variable costs include the cost of sold goods, material costs, and packaging costs. Since advertising and marketing costs always exceed expectations, it should be believed that they will increase in anticipation. Cost forecasting is the scientific estimation of future cost level and its changing trend. Through cost forecasting, grasping the future cost level and its changing trend will help to reduce the blindness of decision making and make the company easy to choose the best plan and make correct decisions. In forecasting cost, the company adopts causal forecasting methods. This method is based on the intrinsic relationship between cost and its correlation. Not only that, the company also forecasts the historical cost of similar products with UU. Income forecast should be combined with market demand survey to forecast the product income. Statistical analysis shows that few enterprises can surpass their competitors in growth rate for a long time, and most of them have similar sales growth rate with industry growth rate in the long run. Therefore, in theory, the growth rate of enterprises cannot be higher than the industry average, especially March. This requires looking for the historical revenue of other similar products on the market and the average revenue of the market. The method of cost-volume profit analysis can be used to predict sales. Cost-volume profit analysis is based on the division of cost into variable costs and fixed costs. According to the internal relationship among sales cost, sales volume, and profit, assuming that two of them are known, another factor is inferred to find the best solution. Using this method, we can predict not only the sales volume and the sales revenue at the break-even point, but also the sales volume and the sales revenue needed to achieve the target profit. Sales forecasting is the starting point of financial forecasting. In many cases, we need to determine sales revenue first, then determine sales costs, and then determine the operational size that need to be increased, as well as the operational replication or additional long-term capital investment and so on. The best way to balance income and cost is through a series of key ratios. First is the gross profit margin, the ratio of total direct cost divided by total income in a quarter or a year. In this part, the company noticed the assumption that the gross margin would increase. Second is operating profit margin. This is the ratio of total operating cost to total income. In this part, the company should take positive measures to increase the ratio. This ratio should increase with the increase of management cost. Companies shouldn't anticipate break-even too early. The final ratio is the credit ratio. Credit ratio is the ratio of current assets to current liabilities. It is used to measure the ability of enterprises' current assets to be converted into cash to repay their liabilities before the maturity of short-term liabilities. Generally speaking, the higher the ratio, the stronger the liquidity of enterprise assets, the stronger the short-term solvency, conversely the weaker. Next, my partner will introduce next part.
And next we begin to discuss the source of startup funders for the company's founder. In the process of launching the venture idea, the companies needed about £800,000. Before the plan started, the company spent about £760,000 in its initial development. The details will be described below. And as we can see from the PowerPoint, the first is the bank. First of all, everyone would think of the lending to the bank. But the bank will lend to the company as a team at UU. A series of facilities are rented and created, such as cash, factory, equipment, office furniture, starting stock, and at the same time, as we can see from the Excel tables, that the rent is kept at about £10,000 per year. In addition to this, the team also has to pay a certain amount of tax and the salary allocated to the employees, which are the expenses that the company has to bear. In the case of credit, the bank will consider the team's collateral and some moral hazard to lend to the company. And the second one is the personal funders. Another way is find some like-minded emerging entrepreneurs to seek help, and also discuss the future development of the industry and introduce the team's products to resonate with product. As an investor, you can choose to join the companies as a shareholder and become a partner of the UU team. And when the companies was founded, team industry property rights, non-patent technologies, and business reputation become intangible assets. At the same time, the founder of the team will seek help from parents and some friends to get the start-up capital. And generally speaking, the company needs certain basic funds when it is created, because UU belongs to the intelligent product of a science and technology. A large amount of funds is needed for the initial investment. And the last one is for the company itself. There are mainly internal financing and external financing. The internal financing mainly depends on the team, employees holding shares, and the surplus accumulation funds. External financing mainly includes stocking financing and bonds financing. UU solved the risk of being difficult to go public through financing and also options a small amount of the funds that are urgently needed for development. And as we can see, the break-even point. We discussed the break-even point, and by calculations, we get the data at about 7,200. This is an indicator of the relative performance of multiple programs. The lower the value and the better. We can see the profit at this time is a positive value, indications that the enterprise has a profit at this time. For the investors, the situation of the enterprise is considerable, and it will generate the opportunities profit of the capital. Due to the fixed cost per year and the different selling prices, the break-even point will be different. And okay, in conclusion, in these presentations, we made predictions based on the cost and revenue, and discussed the reasons for the forecast, and completed the analysis of the initial source of funders for the company. And these are all of our contents. Thank you for watching, and here is our reference.